Hi friends, in this video we are going to discuss how to compute the income from house property. So first one, property let out throughout the previous year. So here the property is let out throughout the previous year. So in that case, how to compute the income from house property? So generally the income from house property is computed by calculating GAV. Then from GAV we have to deduct the municipal tax paid. Then we get the net annual value. From net annual value, there are some deduction. After deducting that, we get the income from house property. So, first we have to compute the GAV or the gross annual value. So, in order to compute the gross annual value, first we have to compute the expected rent. So, the expected return is the higher of municipal value or the fair rent but restricted to the standard rent. This means that the municipal value or fair value, whichever is higher, and higher of municipal value or fair value is compared to the standard rent, and whichever is lower is taken. So that is the expected rent. Now the next step is to calculate the actual rent received or receivable less unrealized rent. Now we have computed the expected rent and the actual rent received less unrealized rent. Now we have to compare the both and take the highest. That highest value is the gross annual value. Now, from gross annual value, we have to deduct the municipal tax paid. Here we have to note that only the municipal tax paid is deducted. Payable is not deducted. Now, after deducting the municipal tax paid, we get the net annual value. From net annual value, there are two deductions under section 24. The first one is 30% of NAV. So there is a flat deduction of 30% of NAV under section 24A. So the second one is interest on borrowed capital actual without any ceiling limit. So interest on borrowed capital. So if any capital is borrowed for the purpose of construction of the building or for maintenance of building, etc. So the interest on such borrowed capital is also allowed as deduction without any ceiling limit. So, there are two deductions under section 24. First one is 30% of NAV and the second one is interest on borrowed capital. So, after this deduction, we get the income from house property. So, this is how the income from house property is calculated when the property is let out throughout the previous year. Now, we are going to look a second case where the let out property is vacant for the part of the year. That means the property is not let out for the whole previous year. Here, the property is let out only for a part of the previous year. In such case, how to compute the income from house property? So, here also first we have to compute the GAV. So, for computing the gross annual value, first step is to find the expected rent. It is similar to the previous one. That is, compare the municipal value and the fair rent and whichever is higher, but it is restricted to standard rent. So, the second step is compute the actual rent received or receivable less unrealized rent for the let out period. So here for how much period you have let out. So the actual rent received or receivable for that let out period will be computed. Now the third step is to compare the expected rent and actual rent received or receivable. So while comparing, we have to look whether the actual rent is lower than the expected rent and whether it is due to the vacancy. So in that case, we have to take the actual rent as GAV. If it is not due to the vacancy of the property for a part of the period, then expected rent will be taken as GAV. Now, if the actual rent is more than the expected rent, then the actual rent is taken as GAV. From GAV, we have to deduct the municipal tax paid. Then we will get the net annual value. So from net annual value, we have deduction under section 24. So section 24A, 30% of NAV, then 24B is interest on borrowed capital without any ceiling limit. Actual without any ceiling limit. Then we get the income from house property. Now we can discuss a question in order to understand how to compare the expected rent and actual rent and compute the GAV. So the question is, Ganesh has a property whose municipal valuation is 2,50,000 per annum, fair rent is 2 lakh per annum and the standard rent fixed by the Rent Control Act is 2,10,000 per annum. Now the property was let out for a rent of 20,000 per month. However, The tenant vacated the property on 31st January 2021. The property was let out only for a part of the period. The unrealized rent was 20,000 and all the conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at the rate of 8% of municipal valuation. Interest on borrowed capital was 65,000 for the year. Compute the income from house property. So here first we have to compute the gross annual value. For gross annual value, we have to compute the expected rent. How to compute the expected rent? So higher of municipal value of fair rent but restricted to the standard rent. So first of all, higher of municipal value of fair rent. Here municipal value is 2,50,000 and fair rent is 2 lakh. So higher is 2,50,000. That is the municipal valuation. Now we have to compare this with the standard rent. Here standard rent is 2,10,000 per annum and municipal valuation is 2,50,000. So restricted to standard rent. So 2,10,000 is the expected rent. Now we have to compute the actual rent received for the let out period. So here the property was occupied by the tenant till 31st January 2021. This means that 10 months. So the property was let out for 10 months. So 20,000 into 10, 2 lakh is the actual rent receivable. So actual rent receivable less unrealized rent. So here there is an unrealized rent of 20,000. Actual rent received or receivable less unrealized rent is 1,80,000. Now we have to compare the both. So here while comparing we can understand that the actual rent received is lower than the expected rent. Now we have to look whether the actual rent is lower due to the vacancy. So here the property was vacant for 2 months. So now we have to look if the property was sold out for that 2 months also, then an additional rent of 40,000 will be earned. So if the property was let out for the whole year, that is for the 12 months, how much rent we will get? The 1,80,000 plus the rent for the 2 months, 40,000 rupees. So total of 2,20,000 rupees will be received. And that 2,20,000 is more than the expected rent, 2,10,000. So here the actual rent is lower than the expected rent due to the vacancy. If the property was not vacant, then the actual rent will be more than the expected rent. 2,20,000 will be more than 2,10,000. So the gross annual value will be the actual rent received or receivable, that is 1,80,000. So now from 1,80,000 we have to deduct the municipal tax paid, and it is given in question that municipal tax paid is 8% of municipal valuation. So municipal valuation is 2,50,000. So 2,50,000 into 8% is 20,000 rupees. So after deducting that we get the net annual value, that is 1,60,000. From 1,60,000 we have two deductions under section 24. The first one is 30% of NAV, that is 48,000. And the second one is interest on borrowed capital. So here it is given that interest on borrowed capital is 65,000. So we can deduct that 65,000. After the deduction under section 24, we get the income from house property, and that is 47,000 rupees. So in this video, we have discussed how to compute the income from house property in case of let out.